Hey, it's Maureen Lein, your local lender from Rate, here with your weekly mortgage update, where I'm going to break down what's happening in the housing and the mortgage markets, but without all the jargon. So today is Wednesday, September 3rd, 2025, and we're going to start with a big picture reminder. Listen, owning a home has historically been one of the best investments you can make, especially over long term. Yes, affordability is tight right now, rates are higher, and appreciation has cooled a bit this year, but context is everything. Home prices have slowed down in 2025, but not reversed. And on a national level and in most major cities, prices are still rising, just not as fast. Out of the 20 biggest cities tracked by Case-Shiller, the average home price is up 2.1% over the past year. A few cities like Dallas, Tampa, and San Francisco are down slightly, but those markets had huge run-ups over the past decade. And here's the key, guys. Most homeowners, they stay in their homes for at least 10 years. And over that time, the 20-city index shows an average appreciation of 88%. Nationally, it's 91%. That's nearly doubling your home value in 10 years. Not bad, right? So let's talk about leverage. This is where it can get a little interesting. Most people don't buy a home with all cash. They put 10% or 20% down and borrow the rest. That magnifies your returns. So if you bought with 20% down, your return on equity is 5 times the appreciation. That means a 10.5% rise in home value translates to a 52.5% return on your money in 1 year. Over 10 years, that's a 441% return. Even with taxes, insurance, and maintenance, the long-term payoff is massive. And remember, whether you rent or own, you're paying to live somewhere, right? The difference is, though, with a mortgage, part of your payment goes towards principal, and there are potential tax benefits for that. Whereas rents, they tend to rise over time, often surpassing what it would cost to own. Now, compare that to something like stocks. You can use leverage there, but they're way more volatile, and you can get margin called or even wiped out. Home values have risen 77 out of the last 83 years, and you're locked into a 30-year fixed rate. That's real stability. Now, let's take a look at what's driving rates this week, guys. So, the July JOLTS report, which measures job openings, that came in weaker than expected, down to 7.18 million, which is 219,000 below forecast. On top of that, the quits rate stayed low at 2%, one of the lowest levels since 2018, excluding the COVID. And what that means, workers aren't confident about leaving their jobs. There's just not as much hiring happening. And job openings, they dropped significantly in sectors such as leisure and hospitality. They're down 47,000. Healthcare and social assistance, they're down 181,000. Retail trade, they're down 110,000. All of this suggests is that the labor market is softening, which is something the Fed watches real closely. Now, what are the Fed officials saying? Let's see. Fed Governor Christopher Waller, he was on CNBC, and he suggested again that the Fed may need to start cutting rates soon, possibly again as early as the next meeting. He emphasized that when the labor market turns, it happens fast, and the Fed needs to get ahead of that curve. Other Fed voices like St. Louis Fed President Muslim and Atlanta Fed President Bostic, they weighed in. Muslim is concerned that if layoffs rise, the weak hiring environment could cause deeper damage. Bostic now, he's a little bit more cautious, still seeing inflation as a concern, and his GDP forecast of 3%, is way higher than most economists who are estimating between 0% and 2%. Now, what about the mortgage rates and applications? Mortgage rates dipped slightly from 6.69% to 6.64%. Purchase applications fell 3% last week, but are still up 17% year over year. Refinances are up 20% year over year. So while the market's still a bit tight, demand is improving, and we're seeing positive momentum, especially if rates continue to ease. And let's talk about a quick technical update. Mortgage bonds are testing resistance. They're at 102.23, which is a level we haven't broken since October of 2024. If bonds push through the next stop, it's going to be 102.5. The 10-year Treasury is heading toward 4.2%, with room to fall to 4.13% or even 4%, which will be great for rates. All eyes now are on the upcoming job reports. And if it's soft, we could see mortgage rates improve even further. So guys, the bottom line for today, owning a home remains one of the best long-term wealth building tools. And despite short-term headlines, the fundamentals remain strong. And if rates continue to trend down, we could see appreciation pick up again as well. So that's it for this week's Mortgage Minute. If you found this helpful, please like and share this with someone who you think is on the fence about buying. And if you're looking to refinance, reach out to me. I'll see you next week with more updates.